All right, welcome. We are at the top of the hour, so we're going to go ahead and get started. Today is Thursday, August 18th, 2022. Welcome to our monthly capital markets update and outlook call for started. Today is August. Mute this here real quick. For August 2022. So we are going to dive right in here today. My name is Eric Hagan. If you're joining us for the first time, I want to welcome you here. I'm a financial advisor. I am also president of Capital Consulting Group, or CCG. CCG consists of myself, of Chief Investment Officer Tom Fox, and financial advisors Dan Oshman and Rana Grant. And then we also have client support, John Knutson and Marilyn Westmark. Together, we steward long-term relationships with our clients and work only for our clients. Together, we can help you see your entire financial situation, both today as well as every year into the future, through our personal wealth planning services. If you'd like to learn more about this after today's message, you can go to clearfinancialfuture.com and watch the short 2-minute video. We also give our clients' life savings the attention it deserves with our SmartMix portfolio solution. SmartMix is our personalized portfolio solution for individual investors, whether you have $25,000 or $25 million. SmartMix is our process for helping you get and stay invested right. If you'd like to learn more about this process after today's message, you can visit us online at smartmixportfolios.com. Speaking of existing clients, if you are an existing client and you're taking some time out of your busy schedule here today, I want to welcome you. Thank you for doing this. Thank you for being here. As you know, we want you to be in the know, which is why we host this capital markets update and outlook call every single month. Last month, we were live at Oak Ridge Country Club. Today, of course, we are online only. And then you can mark your calendars. Next month, we will be online again, September 22nd, and you can sign up for those future events. You can watch recordings from our previous events, all on our website, which is investwithccg.com. Additionally, every Monday morning at 9 a.m., I do a short recap of what happened in the markets the previous week. So you can watch this on our website. You can watch this on Facebook or on YouTube if you are on either of those platforms. And then I send an email out once a week, Mondays at 3 p.m. with a link to the recording and links to anything else that's coming up. So if you are an existing client, you want to stay in the know of what we're up to, I encourage you to be subscribed to that email. And if you could, just take a couple of minutes and glance at that email. Again, Monday afternoon, 3 o'clock Central Time. If you're not getting that email, of course, you can subscribe there as well at investwithccg.com. We have a busy education calendar coming up. We call it our Capital Classroom Education Series. Later on this month, next week, we have 4 keys to cutting college costs. And then the week after that, we have an inside look at qualifying for financial aid. After that, we have some Medicare presentations coming up. We have 30 minutes on Medicare basics. If you are approaching the age of Medicare, that would be a good one to pay attention to. Another one that would be good is called Managing Healthcare Expenses in Retirement. That'll be towards the end of September. And then looking all the way out into October, we have one called 4 Keys to Making a Difference in a Family Caregiving Challenge. So that's going to be a very important and increasingly relevant presentation. So I encourage you to mark your calendar for that. As always, all of our presentations are recorded. We're building quite the library on the website. So if you have questions, you want to go deeper on a subject, it's a great place to start. Of course, we're always happy to have these discussions with you as well. We did a couple of presentations on cybersecurity. We had one called Hack-Proof Your Smartphone. We also had 1 hour to savvy cybersecurity. Before that, we had some retirement planning presentations. So again, a growing library of educational content on the website that you can go and take a look at. And of course, as always, we're more than happy to sit down and talk with you one-on-one on these subjects as well. All right, with that, our agenda today for this month's Capital Markets Update and Outlook call is, of course, to hear from Tom Fox. Tom is our Chief Investment Officer. He's going to talk about the positives in the economy, in the markets. He's going to talk about headwinds, and then he's going to talk about the outlook for the balance of this second half of 2022. This is kind of your opportunity to look over our shoulder, get an idea of what we're seeing and what we're watching for. So I will be monitoring the chat box. If you have any questions, please don't hesitate. If you are watching this in the replay, you are also invited to send any questions that you have, and we will be certain to follow up with you and get back to you. We've got just a wealth of information to share. Tom is a wealth of information. Tom spends all of his time kind of more behind the scenes, doing market research, due diligence, running different analyses, and really focusing his attention on the economy and markets. He's got over 35 years of experience building investment strategies. As you can see on the screen, a very long, impressive resume. So with that, I'm going to go ahead and turn it over to you, Tom. Boy, oh boy, have things changed in the last month or two, huh?
They have. Thank you, Eric. Hello, everybody. Good morning. So I'm excited to address you today. And if we look back, we have been saying really all year that it was going to be a really rough first half and that we would go into a correction. Now, correction is -10 in the S&P 500 because that's the index that we were talking about. So the S&P would go into a correction that's -10 to -19.99. Now, as you know, we actually went over that line just for a few days. We entered a bear market. And then you'll probably heard on all the cable networks about how we're in a bear, and they keep talking we're in a bear market. Well, we were only in a bear market for a few days. We've been mainly in a correction, but that has changed. So what's happened, we have been saying that we're going to have a good second half. And I've actually, at the end of this presentation, put a number in for the S&P 500. I was reluctant to do it, but I think Eric wanted me to put a number in there. So we did put a number regarding our forecast. So what's happened? Well, the S&P has jumped to a 3-month high. And believe it or not, it's up 18% from the bottom. And we're no longer in a correction. It's down about 9.5% right now. That was even after yesterday's down day. And so the market currently, the S&P 500 is no longer in a correction. And so if you hear the word bear market, we're about 11% or 10.5% away from a bear market. The NASDAQ rallied 23% from its bottom. So we saw a huge upswing. Now the NASDAQ was down around 30%, but that has made a big comeback as well. And what's also interesting is the VIX, which is a measurement of volatility, falls below 20. Now, normally a number below 20 means risk on. So that's the first time since April that's occurred. It's been above 20. It's been as high as close to 40. So which means risk off. But what's happening is that more and more investors are starting to come into the market. And what's causing all this is inflation is cooling, and a soft landing, maybe many months ago seemed improbable, now seems even more possible. So we'll see what the Fed does, and we'll even look at a chart that says what the Fed's outlook is for the economy. So, but I wanted to hit this up front. There is a big wall of worry. And I can't remember in my long career where we've had so many investment strategists that do what I do that are on different sides. It's very mixed. In fact, if I would say overall, there's more strategists that are more negative or bearish than there are bullish. But there are some bullish strategists out there, well-known names like JP Morgan and so on. But I took a kind of a survey or list of what investment strategists, why are they negative? Why are they so bearish? And there's a lot here. The Fed is raising rates, which typically means stocks are going to go down. This is what strategists are saying today. The Fed may over tighten, so they're worried about that. And there's a number of strategists or investors that see inflation as being sticky, that it's not going to go down. It's not going anywhere near the 2% target of the Fed. But it's going to be like the 1970s and 80s, where remember we had super high inflation and it stuck around for many years. And also, so what they're saying is inflation is going to linger and linger and linger, and that we're not going to get relief. It's very sticky. So this is a worry that strategists have. Some even believe we're already in a recession. Now, remember, we had 2 negative quarters of GDP, but the NIBR, the NBER, who decides whether or not we're in a recession, this doesn't qualify as a recession. And I put it out in one of our earlier pieces that what's necessary is persistent downturn in the economy, and we're not seeing that right now. Or some are saying it's going to come this year, but it just hasn't arrived yet. Now, I have a chart later on we're going to look at. It was the recession that was not. So that should get some feedback on that one. But stocks, here's what they're saying is stocks are rising only because of technical reasons. This is just sort of a bear market bounce or a technical bounce, but there's no fundamental reason for stocks to be going up, especially if someone cares about earnings and the economy is slowing. So we're going to address that and why we are more bullish. And also, which they have a good point, the valuations have not come down enough relative to past bear markets, because typically when you get into a bear market, there's a big PE drop. Now, we did have a decent PE drop, but it was nowhere near historical bear markets. And overall, there's just, as I listen to, and maybe what you hear on the cable news, is there's deep skepticism. Some investment strategists believe we're going to reach lower lows. So I wanted to put this out. We're aware of all the arguments. So we're not standing, not listening or evaluating all these. We are evaluating all these, but we are still bullish with some other investment strategists. But there are a lot of smart people out there. They're on both sides of the camp. So why are we positive? And why perhaps you should stay invested or start even buying stocks if your advisor says to do that. But because inflation has shown a pronounced break in its pattern. It was up, and all of a sudden, the CPI drops 9.1 to 8.5. That's a big drop. And we're expecting the next print to even be, it's going to be heading and trending in the same direction. Also, the July PPI producer prices are also came in lower than expected. That's the wholesale prices that we pay retail, but what are the companies paying? And those are deflating. So in talking about, I want to just mention this because Eric said there were some calls about, we're going into deflation? No. What I'm saying is that inflation's coming down, it's deflating from where it was, and we expect it to go down maybe over the next 6 months to 9 months back down to the 2 to 3% range. We do not think we'll have negative inflation, but we do see it deflating. So another thing that we've been saying is that employment is very strong. This is not typical of a recession. We just came out with another employment number, and it's at a 40-year low. So this is not typical. A lot of people have jobs. There's a lot of openings in jobs. This is not typical of a recession. And we've been saying that any less bad news or good news, the stocks will be amplified to the upside. And that's exactly what's taken place over the last month or so. So the economy is still expanding. It's no recession yet. We look at the numbers and we don't see a recession coming this year. And many were predicting earnings recession. That's not happening either. They're coming down, but they're not anywhere near recession levels. So corporate companies, especially in the energy sector, are doing really well. Households and corporations still have plenty of savings to keep spending. And here's a couple things here. The advanced decline is at an all-time high. What does that mean? That means that the number of stocks going up versus the number of stocks declining is showing a robust all-time high. This is very bullish for the stock market. In addition, that the number of stocks in the S&P 500 that are above their 50-day moving average is now over 90%. That's very bullish. So what does that mean? There's more stocks participating in this rally, and they're all beginning to move above their 50-day moving average. Another indicator, and this is in the fixed income area, when we look at high yield spreads, riskier bonds versus safe bonds, what that spread is, it's a very good indicator on telling us, are we heading into bad times or good times? And right now, if you look at the high yield spreads, they've come down greatly, and they're pointing to growth, not recession. So, and this is a very much of a forward-looking indicator, and that is saying we're not in a recession. So these are the positives, and we're going to look at charts regarding some of these things to give you some hard data behind it, why we believe it's a good time to get into the market. So here's the first one I want to look at is stock market breadth. That's how many stocks are participating. We've seen the small cap index rise very greatly. So here's the 50-day moving average. You can see that it was down around 2% in that first circle, and now it's over 90%. This is the number of companies above their 50-day moving average in the S&P 500. This is really bullish when you have this many companies participating in this rally. Now, typically when you just have a few companies, maybe just a couple tech companies, or just maybe one sector of companies that are doing well and are above their 50-day, and it's the rest are below, then you have to be suspicious of this bull movement. But because of the breadth of all the stocks participating, that's really a good sign. And here is the advanced decline line. You can see in the lower one, it's at an all-time high. This is how many stocks are above going up versus down. And you can see it's a record high. So this is, what is this saying? This is saying there's some momentum behind this bull market. And right now, if you look at many of the hedge funds, many of the big institutions, they have cash. They were out of the market or even short. Those committees for all those institutional funds and hedge funds, they're meeting because they got to decide what to do. And if they decide to come back in the market, boom, this market's even heading up higher. Okay, so here's the high yield spreads. If you look for the far right, the growth scare, so the spreads go up when we're going into recession, but look what's happened recently. The line has come down. That means they're getting scared that this economy is not going into a recession, but it actually will stay in growth. So the risk taking is increasing to go into riskier bonds. So the spread between riskier bonds and high quality bonds is not high. This is a very bullish signal. Now this chart shows, remember this is the 1980s, 70s, and 80s where we had significant inflation, much higher than we've had this year. And what's interesting is that we have 3 points where Volcker made some decisions. And if you look at the far right blue line, you probably can't read what's being said there. It's where Volcker is suggesting that he's going to ease on interest rates. But what happened was the market moved before he said that. And look what happened. The entire, this is another inflationary period, the entire drop into a bear market, minus 27, was erased in 4 months. This is what we think is going to happen this year. This could be a repeat of the early 80s, where the inflation was high and the Fed, this is way before they started cutting rates, by the way. This is discounting that they are going to cut rates or stop raising rates, and the market had already moved, and in 4 months recovered all the losses of that 27% drop. We could have a repeat, we're not sure, but we could potentially have a repeat of the 1980s. Now, if we do go into a recession, which we're not forecasting this year, maybe next year, when we get closer to the end of the year, we'll make that decision. But in a bear market, typically the average recession is 12 months and the average bear market is 7 months. What does that mean? That the market moves well in advance of the end of the recession. So if you're in a recession, you need to, and we find out we're in a recession, even if one comes, the stock market will come out of its bear market well in advance of the end of the recession. It's about 6 months difference prior to that on average. So you can see that in this chart. Now, we're not predicting this for this year, but it maybe in 23 could happen. We'll wait to see. Okay, are we in a new deflationary period? Now, I don't mean sub-zero inflation. I'm talking about inflation is heading south. This trend may be starting, and this is some of the markets see much lower CPI, and this is for the rest of 22. And if you look at the average, what is expected, it's a 2% inflation rate. That's what is expected over the next 6 months. Now we'll see if that happens, but that's very deflationary. This is a forecast of what the market is saying could happen. Now here's what companies are paying for goods, the producer price costs. Look at that. We haven't had a negative producer price number since May of 2020. And you remember what we were in right at the beginning of the pandemic where prices tailed off. Look at, it's been higher, 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 and look what's happened. It just went negative. That is a good sign for coming inflation. Here's crude oil, down 11% since June. Commodity prices have rolled over. These are all good indicators that we're heading into lower inflation, which we've been saying for months. Here's gas prices. You can see we're close $5 a gallon. I just went yesterday and it was $3.70. These are 3 different potential scenarios. Could go to $3.29. These were 3 forecasts, $3.54, or actually $4.03. This is national. Eric, I just went to the gas pump, filled my car up. It was $3.70 for a gallon of gas. And that's not too bad. I get the middle of the road too, not the premium, not the low, but the middle. It was $3.70. So that's not too bad. So we're seeing gas prices come down. This is like a tax credit to people, tax break essentially. So this will be good for the consumer if this continues this trend. Also, this is a chart of the global supply chains. They're improving. Delivery times are coming down. The cost to ship is coming down. So this is a global supply chain pressure showing it's easing. You can see it's coming down, and it's really heading. It's heading towards the pre-pandemic era. So we'll see what happens. Hopefully this continues. We think it will. This is all good for the upcoming inflation numbers. So the economy, here's my title. I said it earlier, the recession that was not. Many people have been predicting a recession. It's not happening. In fact, the Fed is very optimistic on the economy. They're saying their target inflation numbers as they raise rates will not smash. This is what they believe, will not smash growth or jobs. So the growth path that they have indicated is very similar to the pre-pandemic numbers. You can see the lower number, the red, but look where we're heading, and it's just slightly below what they forecasted in the pre-pandemic era. So this is saying the Fed is saying that the GDP or the growth of the economy is still going to be very strong as we go into 23 and 24. So this is good news. The Fed doesn't think we're going into recession. They don't think their target rate and that impact on inflation will mess up growths and jobs, the growth of the economy or jobs. They still think we're going to be a positive for the GDP. Here's the real number. This just came out in July, so we can see that anything above 50, which is the bottom of that graph on the top, that means it's expanding. And you can see that services went up. The PMI services actually went up, and we've been saying that there was going to be a difference, that services were going to make a move upward. You can see manufacturing is down slightly, but it's still holding. In fact, the Philly Fed just put out I think it's called the Philly Fed Index, which is an index of manufacturing. That came out plus 5%. The estimates minus 0.5. So there was a big surprise on that region, the Philly Fed Index, which is an index of measuring manufacturing, that surprised to the upside. We're not seeing things slow down heading towards a recession. As we said, we believe it's still going to be, and you can see the payroll, non-farm payrolls were up too. So everything in the employment and even the economy is looking good. So here we've been talking about unemployment. We just came out with a new number, 3.5%. Last time we saw anything like that was in 1969. This is, again, not what you would expect if we were actually in a recession or going to be in one soon. We wouldn't see unemployment like this. So this is a real big reason why we think we're going to avoid a recession this year. Now, we've been talking about, many people have been saying that the second quarter, that the earnings and revenues were going to be in a recession. We're heading down. But you can see the number of companies beating the analyst estimates. You can see the two circles, 75%. 3/4 of the companies outperformed what the analysts expected for earnings. It was a 1.8 positive surprise. And if you look at the right chart, which is the top line or the revenues, you can see that 71% of the companies outperformed what the analysts were expecting, a whopping 3.5% higher revenues on average. These are good numbers. These aren't a recession for earnings or revenue. And we believe that the third quarter may be less than this, but we do not see earnings or revenue recession. Okay, with all that, what do we think is going to happen? We've been calling this since, was it last year in December, we said the year of transition?
That's correct.
We called it the first half would be bad and the second half would be good. And so far, through the grace of God, we're right on that. So this is the year of transition. And in the balance of the second half, we've already had a big move in the stock market. The economy is not showing recession. Earnings are not showing recession. So things are going, this is the year of transition. And this is mainly, the transition was good stock returns versus bad stock returns in the first half. So we see inflation surprising to the downside. We think that's going to continue. We see gas and commodity prices drop more than expected. We're expecting corporate earnings and revenues to beat estimates again, like we did in the second quarter, in the third quarter. And the consumers keep spending. There just was a number that just came out recently that the consumer is not pulling back. They're spending all that money they saved during the pandemic, again, mostly in the service sector. So no recession in 22. We'll talk about 23 later in the year. Midterm election stock market rally. Now, I've talked about this before, but during the first half of a mid-year election, midterm election, typically the market averages 1%. In the second half of a midterm election, it averages 13%. So we think that's a boost. That's a kind of a seasonality play, and we think that's going to continue. So we are putting a forecast 4,900 to 5,000 by the year, and this would be a new high for the stock market, which was just below 4,900. So we're expecting we're going to go to new highs. Now we're at the very high end of what others are saying. JP Morgan is up there in the 4,900, and I think there's one other, but there are a few other big firms that are saying we're going to have a good stock market the second half. So we think this rally is only beginning. We think there's more upside when the inflation numbers come in better and better. And we've been talking about inflation. We've been saying all along that the leading indicators of inflation, the leading inputs that would finally get in the CPI number have been dropping. And then we saw the first one, this last CPI number, drop down to 8.5. We are expecting that to continue that trend, and that will be very good for stocks. So we are expecting, we're bullish. We're not alone in being bullish, but it's the minority of investment strategists out there, but we're happy in being bullish.
Bullish is good, Tom. That's great. So with that, I'd love to open up the call to any questions that anybody has. I've been watching, we are live on YouTube, watching the chat box there. I'm also watching the chat box on Zoom. If you have a question, I see we've got a number of people out there. So if you've got a question for Tom, I would love to present that right now. Feel free to go ahead and drop that in the chat box. If you are watching this in the recording and you have a question, feel free to comment below this video if you're on YouTube, or I think I'll put it on Facebook later as well. So if you're watching it on Facebook or YouTube, feel free to comment down below. If you're watching it on our website, feel free to shoot me an email. Would love to circle back with you and get any answers to any questions that you have. Tom, I do have a question for you. When we look back at the stock market the last 5 months or so, we've had it's been a wild ride, right? There's been a lot of ups and downs, a lot of volatility. When we look forward the next 5 months, I love your forecast. It's something to definitely look forward to. Do you think it's going to be a slow charge higher up to those numbers? Do you think that there could be any big shocks that would not necessarily mean we don't end the year back there, but that we might see some pullbacks in between? What do you think about volatility between now and the end of the year?
Yeah, that's a good question, Eric. I think the VIX will probably begin to stay below 20, which means that would be a risk on. That's lower volatility. But I do think we're in a 2 steps forward, 1 step back. This is not going to be straight line. There will be some volatility up and down, because there are a lot of people that are very negative on the market. There's a lot of skepticism on whether this market can continue upward. And again, I went through all those lists of what other investment strategists are saying. So I do think we're going to have some volatility up and down in terms of return. It's not going to be straight line, but I think it's what I'm saying. It's going to be very jagged, but it will end up much higher than we are even right now. That's because we're seeing really good inflation numbers coming soon, like we saw last month.
Very good. Thank you. And for all of you watching, what that means is that if we do see volatility, as Tom said, 2 steps forward, 1 step back, if we kind of get in the mindset to expect that, we don't need to get worried about that volatility. We're away from the first half of the year, which was maybe 1 step forward, 2 steps back. And now we're in a different environment where we're 2 steps forward, 1 step back. So if we do see pullbacks, in between here and the end of the year, it's not something that we want to get worried about for sure.
Absolutely.
Yeah, so thank you. So with that, I am going to glance at the chat box here one more time across the different screens here. I don't see anything, so I guess we'll wrap it up. Tom, do you have anything else you want to add before I do?
No, I think that, we've been saying all year to have patience. We've been saying all year that the first half was going to be very rough and difficult. But now things are starting to come together. And we think there's going to be a lot more believers in this bull scenario. There's not that many right now, but we think I think as the inflation numbers, because the main culprit has been supply chain and inflation. That's both those are dramatically improving. There's a break in the trend. We think we've seen our peak in inflation. And now we think it's gonna, like next month, it's going to be another good number. And when the market sees that, it's going to be a bullish move upward, because we can see how they responded to the low CPI number. And even the Fed was talking about maybe making a little dovish tone. Of course, there's some others that were saying, well, we interpreted him wrong back when Paul was making the comments that really ignited this this rally. He was just saying, hey, we're going to be data driven. And if we see things going in the right direction, we may not raise rates as much. Now, they're not talking about stop raising rates yet. They're not talking about lowering rates. But what that was they are going to be data driven. And we think the data that's coming forward will be very good.
Very good. Great. Well, thank you as always, Tom. Really appreciate your objective analysis, the weighting of it, the balanced approach, positives, negatives, and outlook. So thank you very much for today.
Thank you, Eric. Thank you, everybody. And we'll
And
see you on the boat.
Yeah, for those of you on the boat, we're really looking forward to it next week. Thursday night, we have pretty much a full boat. So if you're going to be joining us, we're really looking forward to that. If you have not RSVP'd, you can go to the website, put your name in. We do have a bit of a wait list going. We have full expectation that we can get you on. So if you're interested and you have not RSVP'd, please do go and do that. But I would encourage you to do that right away. And yeah, so looking forward to that. Looking forward to our update next month. And with that, I will sign us off. So thank you, everybody, for taking some time out of your busy schedule. And that concludes our call today.